All right. I'd like to take this opportunity and discuss time value of money and the discounted cash flow. So this is built upon the first class in finance, and we are kind of reviewing what you have known from that class, as well as inserting a few new things in Excel. Okay. The objectives are outlined in the lecture notes. After we're done with the lecture, you can come back and review those objectives, okay, and see whether you have achieved all of them. All right, so let me start with a discussion of the timeline. The reason I want to start with the timeline is because it's very easy to illustrate the first two fundamental concepts in finance, that is the present value and the future value, by using a timeline. And as you can see in a second, it's very easy for you to build a timeline. Okay, so I can build a very simple, let's say, calendar timeline. All right, so a timeline is a line of time where time progresses forward. So really, our convention is to go from left to right. So here in Excel, if I want to build a timeline, I can build a very generic timeline. So for example, period 0 is for today, and watch closely what I'm doing here. I'm building a formula. So I have one period from today, but I don't have to simply type down one here. Instead, I can do a little formula. All right, so my cell C4 is actually a formula that's actually referring to cell B4. Well, B4 is 0, so B4 plus 1, that will get me 1. All right, so now I can actually, put my cursor here on the bottom right corner. My cursor becomes a cross. I can hold my left click and drag it. Okay, so now you see that I just built a 7-period timeline. And this is the so-called copy across. Okay, a very useful trick in Excel. In this case, I'm actually copy to the right. In some other cases, I can actually copy to the left. So let's say, this is today, and this was the previous period. So I can just say 0 minus 1. So I have the previous period and the previous 2 periods and so on and so forth. Okay, so I can actually copy, across as well. In this case, I'm actually copy to the left. Okay, as you can imagine, in some cases, you want to build a vertical timeline, so you can actually copy down or copy up. All right, so for example, when you're trying to do a loan amortization table, you might want to set up the vertical timeline. Okay, so this is the the very nice trick in Excel. All right, I can also use for example, build a calendar date timeline. So today is, all right, so I can actually use a function called today, which actually will give the date for when I'm making this video. All right, if you don't want to actually have the today function, you can actually set up a date function here. So let's say this is 2021. This is June the 12th. Okay, so you can actually build today, and you can match this with your period timeline. This is 0, and now your timeline is progressing to the right. So your period could be defined by a month. All right, so if it's actually defined by a month, I can actually say some of you will say, well, it's going to be July the 12th of 2021. All right, and that is going to be labeled as period 1. Okay, so you can actually manually type in July the 12th of 2021, but I'm going to do a little coding here so that I can actually copy across. So I'm thinking, all right, I'm trying to get July the 12th of 2021. So I know I'm going to actually use the date function here again. So that's going to be the year of the previous date. So I take the year function. Okay, so that's going to be 2021. All All right, so I'm using Excel functions already, but these Excel functions are fairly straightforward, so there's no need for me to elaborate. All right, and then I'm going to take the months of today's date, so that's just going to be 6. And I know I want to actually add 1 month to it, so that's going to be July now. And I can take the day of today's date, that's the 12th, all right? So now you see that this is now fairly complicated because I'm using 4 Excel functions all together, but you will actually appreciate, why I'm doing this in a second, all right? So if I press enter, I get, July the 12th of 2021. And now what happens if I copy across? Okay, so these numbers are actually hidden because they do not have enough space to display. So I can just, double click, highlight all the cell, all the columns where the numbers are hiding, and double click, and you see that now I'm actually fast forwarding by 1 month every time. All right, so this is July, this is August, September, October, November, December, and now this is actually January of next year. So this is monthly frequency. All right, so I can match this with my period timeline here. So the month of January 2022, that would be the 7th periods. Okay, so you can actually use this kind of a timeline when you want to value equities or stocks. All right, so that is a very simple thing to do. Okay, so the second concept I want to illustrate is, as I said, present value and future value. All right, so you know how convenient it is to build a timeline. So now if I have the timeline, I can just pick 2 points along the timeline. Okay, well, I should say I should have picked 2 different points. All right, 2 different time points. Okay, so if that's the case, you can always have a timeline. You can always pick 2 points. As long as they're different, then there's going to be a time point that's earlier. There's going to be a time point that's later. All right, so the value or the cash flow, all right, that corresponds to the earlier time point. Okay, I'm taking a lot of notes here. Sometimes I'm using short notations. All right, so the value of the cash flow that corresponds to the earlier time point, that's present value. All right, so the value / cash flow that corresponds to the later time point, that is future value. So this is how we define present value and future value. All right, so just because present and the future doesn't mean we're going to actually interpret this from the conventional sense. Instead, we're going to build a timeline and pick 2 points and rank these 2 points or sort these 2 points. The earlier time point, the value or the cash flow there, that's present value. The later time point, the value or the cash flow there, that's future value. All right, so you may ask me, what is a value? A value is like, for example, a deposit or a payment, okay, or a loan. All right, so you can think of those as the cash flows. All right, so that is straightforward, but sometimes it is not that straightforward, because we have the confusion from let's say our conventional wisdom here. All right, so let's just look at example number 2. All right, example number 2 on your lecture note. Okay, so $1 invested 25 years ago. All right, that can be a case of future value if you're interested in knowing the value of such $1 50 years ago. Okay, why is that? Well, because we're talking about 2 time points here. One is 25 years ago, so I'm just going to say negative 25, and one is 50 years ago, so negative 50. All right, so now you're saying you have picked these 2 time points because these are the relevant time points in this example here. So the value here, well, that is future value. All right, the value here in 50 years ago, well, that's present value, right? Because that is how we define them. Okay, this is the earlier time point. That's present value. This is a later time point. That's future value. So now you see that this is actually conventional, because we're talking about 25 years ago, and yet we're talking about future value, for 25 years ago. That's because you're comparing this to 50 years ago. Okay, so don't let the conventional wisdom confuse you. All right, so let's look at example number 3 here. Okay, this is going to be a little more challenging. All right, you may have done this in your first class in finance already, but you can actually see how conveniently you can actually solve this in Excel. All right, so you have $10,000 you want to invest for the next 40 years. All right, and you're offered an investment plan that will pay you 8% per year for the next 20 and 12% per year for the last 20. Okay, by the way, when you are watching this video, it is a great idea to have your lecture notes, side by side, so that you can actually refer to it. All right, this is a great habit, and I want all of you to be aware of this. Okay. All right, so you have $10,000 you want to invest for the next 40 years, and you have an investment plan that will pay you 8% per year for the next 20 and 12% per year for the last 20. Okay, the question is, how much will you have at the end of the 40 years? And also, does it matter if the plan pays you 12% per year for the first 20 and 8% per year for the next 20? Why or why not? All right, so let's analyze this question a little bit. All right, it's always a good habit to analyze the question before you actually attempt to do anything in Excel. Okay, do not jump directly to Excel, because Excel is just a way of getting things done. Your understanding always comes first. All right, so we're talking about investing $10,000, and we're talking about next to 40 years. Okay, so that apparently is information about a very interesting time point. All right, and you have the investment plan that will pay you 8% for the first 20. Okay, and then 12% for the last 20. All right. So you see that we have 3 interesting time points here at the least. All right. So first of all, you have today. All right, and then you have 20 years from today, and then you have 40 years from today. Okay, so these are the time points referred to in the example. That's why we pick them. So your analysis is always depending on the question, on the situation here. All right, so you know that you're going to invest $10,000 here. So there's a cash flow here. This is the time point. All right, and this is the value or the cash flow. All right, so we're trying to cast this question in our framework, in our simple but easy to understand, a framework. Okay, and this is asking what is the value you're going to have at the end of 40 years, knowing that you're going to receive 8% for the first 20 and 12% for the last 20. So let me ask you a very simple question here. All right, so we have 3 time points. Now this makes our present value, future value discussion a lot more interesting. All right, so first of all, the value here in year 40, is that a present value or is that a future value? Okay, remember, when we define present value and future value, we're always picking 2 time points. The earlier time point, that's present value. The later time point, that's future value. Now in this case, you have year 40. If you compare this to year 20, well, that's future value because year 40 is a later time point. If you compare year 40 to today, that's also a future value because year 40 is after today. So we know it doesn't matter which 2 time points you're picking, this is always going to be a future value. All right, so that is very clear. So we're looking for the future value here. But here, in year 20, what's the value here? Is it the present value or is it the future value? All right, so this is a very interesting question because you have an intermediate, time point. All right, so here's the answer. Listen up. All right, so When you compare year 20 to today, year 20 is a later time point, so that's a future value. But when you compare year 20 to year 40, year 20 is an earlier time point, so that's a present value. So in this case, the value here in year 20, that's a case of both. It is both present value and a future value. All right, so that's our detailed analysis. Okay, so you see that when you have more than 2 time points, the value that stand at the intermediate time point, that can be a case of present value and a case of future value. So this is actually how we're going to solve the problem here. All right, step number 1, we're going to actually calculate the future value at year 20. Okay, based on the present value today of $10,000. By the way, this $10,000, that's always present value for sure because it is the earliest time point in this 3 time point case. So this is present value for sure. So I'm going to calculate the future value at year 20. So if you still remember what you did in your first class in finance, future value is equal to present value, which is 10,000, multiplied by 1 plus R. So we're doing the compound interest here. The interest rate for the first 20, that's 8%, raised to the power of 20. All right, so that's how you actually do this calculation in Excel. I'm sure you guys know how to do this using a financial calculator, but here we're actually doing this in Excel. So this is how you actually do it. This little sign here, this is actually raising to the power of. Okay. All right, so that's our first step. So this is telling us the $10,000 today is equivalent to 46,609.57 in 20 years at the interest rate of 8% per year. Okay, now step number 2, we're going to use the above future value as the quote-unquote present value because now we're actually going from year 20 to year 40. So year 20 value there is a present value. All right, and use the above future value as quote-unquote the present value to calculate the future value in year 40. All right, so I'm going to actually do this as well by the formula I just mentioned. So that's the present value now multiplied by 1 plus 12% raised to the power of another 20. Okay, so this way you can actually find out how much you're going to have at the end of year 40. This is actually 449,609.60. All right, so that is the example number 3. So very easily you can imagine you can actually have 4, 5, maybe 360 time points. For example, for a 30-year mortgage with monthly payments, right? 30-year mortgage, monthly payments, that's 360 time points. So imagine all the cash flows in the middle. If you want to interpret, they can be interpreted as both present value and future value. All right, so just bear that in mind. Okay, so that is our definition or framework for present value and future value. All right, so now let me talk about cash flows. Okay, so my bullet point. Well, I should just actually say the interest rate. Okay, the interest rate is denoted by R. Sometimes it's denoted by I. Okay, you have seen this kind of notations all the time. All right, this is the speed at which money grows interest. Okay, so there are so many different kinds of interest rates in the financial market. If you take finance, financial markets in the future, institutions in the future, you will have a more detailed look at all the different kinds of interest rates in the financial market. All right, so money can grow interest at very different speeds. Sometimes money grows interest very fast, other times money grows interest very slowly. It may also depend on who is actually managing the money. All right, so for example, checking account, money barely grows any interest. Okay, if you put money in your checking account, a bank says, I provide you with the convenience of writing a check, so I'm not going to give you any interest. All right. savings account, money does grow interest, but it grows interest very slowly. All right. Of course, with the inflation rate surging, you can actually imagine maybe the interest rate is going to go up as well. All right, and then you have if you're not satisfied, you can actually put money into some kind of CDs, certificate of deposits. So these are basically time deposits, and your money is actually locked down for, let's say, 2 years, and you cannot touch the money. So they're going to give you a little higher interest rate. All right, and if you're still not satisfied, you can actually start to take more risks, and you can actually start investing in, let's say, treasury bonds. These are borrowings by the U.S. federal government. Okay, so U.S. federal government, they actually borrow on a short-term basis, also long-term basis. They issue T-bills, T-notes, and T-bonds. So you can actually invest in them. All right, they are very accessible to you. Okay. If you're still not happy, you can actually take more risks and invest in corporate bonds. You can actually get higher interest, or higher rate of return. Of course, you're taking more risks. If you're still not happy, you can actually go with maybe, I don't know, equities. All right, stocks. Okay, individual stocks. Stocks that can be sensational. For example, marijuana stocks, or electric car stocks, and so on and so forth. All right, and yeah, if you're still not happy, you can actually go with, I don't know, maybe some kind of hedge funds, private equity. Right, so these are the things people are talking about all the time. So star hedge fund managers, they can actually be very successful in picking the right stocks. They do a lot of sophisticated trading strategies, and they can actually earn great returns. Okay, so that is these are the different examples of the speed at which money grows interest differently. All right, so now let's look at the cash flows. So we're going to actually make a distinction between single cash flows versus multiple cash flows. Okay, single cash flows versus multiple cash flows. All right, so let me actually focus on single cash flows here for a second. All right, so okay, a single cash flow is defined as the cases where you have, for example, made a deposit and you want to restore your deposit after some time, or you have taken a loan and you want to actually pay off the loan after some time. And during this period, or during all this time period, there is no other cash flow in between. So really, you're having two time points. You have the present value and the future value. All right, and there's no intermediate cash flows. Okay, so only present value and the future value. No other cash flows in between. All right, so this is the case for single cash flows. All right, so as I said, you make a deposit and you want to actually restore your deposit after, let's say, 5 years. All right, and that would be a case of single cash flows. All right, so if you remember from your finance 201, which is the first class in finance, future value is equal to present value multiplied by 1 plus r raised to the power of t. Okay, so we're talking about compound interest here. Okay, we're not talking about simple interest. All right, so just to refresh your mind, simple interest is the case where you only earn interest on the principal and you're not earning interest on the prior interest you have earned. All right, whereas compounding interest is you earn interest not only on the principal but also on prior interest you have earned. Okay, so if you know the present value, if you know the interest rate, if you know the time period, if you're dealing with annual compounding, then you can actually find out the future value, which we did in example number 3. All right, so I should actually say this actually is the annual compounding. Okay, all right, so we can actually extend this to any other compounding frequency. All right, so I'll talk about that in a second. All right, so future value is equal to present value multiplied by 1 plus r raised to the power of t if you're talking about annual compounding. All right, and of course you can manipulate this equation so that you can actually get present value. So present value would be equal to future value divided by 1 plus r raised to the power of t. If you want, you can actually get an equation for t. All right, I'm not going to go through the algebra, but I will show you how to calculate this in Excel by using Excel functions. You can also get a equation for r. Again, this equation is actually a little messy. It's purely algebra, so I'm not going to try to confuse you for that. All right, so these are the cases for annual compounding, and you have 4 equations here because you have 4 quantities. If you want to actually move on to any other compounding frequency, then I'm going to actually introduce a parameter k. K is defined of number of periods in a year. So k is the compounding frequency parameter. So if you're talking about monthly compounding, k is equal to 12 because you have 12 months in a year. So every month your money grows interest. All right, your money compounds interest. All right, if you're talking about quarterly compounding, all right, so you have 4 quarters in a year. So your money grows interest 4 times in a year. If you have daily compounding, all right, well k is actually equal to 365. All right, so we ignore 366, the leap year. All right, if weekly, all right, k is actually equal to 52. All right, you have 52 weeks in a year. If it's semi-annual, all right, bonds may pay actually semi-annual coupons. So if that's the case, k is equal to 2. All right. If you're actually talking about continuous compounding, well, k is actually approaching infinity. Okay, so this is the concept where you may actually get to deal with in your graduate level finance class. All right. So that is the different compounding frequencies. And now if you want to actually look at these 4 equations here, you can actually look at future value. So future value is now equal to present value multiplied by 1 plus r over k, all right, raised to the power of k times t. All right, so now everything is actually very generic. You can actually consider different compounding frequencies in this manner. All right, so you can also look at some other equations down here for present value, for r, and for t. I'm going to skip those equations. You can review those, on your own. But I'm going to show you how to do this kind of things in Excel. All right, so let's now move on to some examples here. Example number 4. All right, on your lecture notes. So let's see what this is. Okay. So Harry D'Angelo is investing $5,000 at a stated annual interest rate of 12% per year, compounded quarterly for 5 years. What is his wealth at the end of 5 years? So we're trying to actually find his wealth after 5 years. So really, the analysis here is very simple. All right, but just to try to encourage you into developing this good habit. All right, I'm going to look at today, and I'm going to look at 5 years from today. Okay, so these are the two time points, and there's a cash flow here, 5,000. All right, and this is asking how much this person is going to have in 5 years, and the compounding frequency here is quarterly. Interest rate is 12%. Okay, so we're looking at this equation here. So future value in 5 years. All right, so I'm going to use the formula here. Okay, so future value is equal to present value, which is 5,000. Right, that is obvious. The 5,000 is the earliest time point. That's the present value. Multiplied by 1 plus r. Well, in this case, you're talking about 12%. But this is quarterly compounding, so your k is equal to 4. So 12% over 4 raised to the power of k times t, which is 4 quarters in a year times how many years? of 5 years. So that's 20 quarters. So that is $9,030.56. Okay. Let me actually discuss a little bit about Excel functions here. I can actually use Excel feature value function to calculate this. Okay, so let me actually show you how to do this calculation, how to replicate this number here first, and then I'll discuss the details about Excel functions. Okay, so the rate is actually 12% over 4. Number of period here is NPR stands for number of periods. So that's 4 quarters per year times 5 years. So that's 20 quarters. Payment here is 0 because this is single cash flows. Okay, present value is negative 5,000 because you are investing. All right, so present value is 5,000, but for some reason I want to sign this as negative. All right, so if I do that, yes, I replicate the number. Okay, so a few things about Excel functions here. All right, so first of all, you have feature value function, present value function, rate function, and NPR function at this moment. All right, we just use the feature value function to calculate the future value. So if you want to calculate the present value, you can do the present value function. If you want to calculate the rate, the interest rate, you're going to do the rate function. If you want to calculate number of years or number of periods, you can use the NPR function. Okay. Secondly, everything in Excel functions is in periods. Okay, so this says, if you're looking at the interest rate, it is the interest rate per period. If you're looking at number of periods, it's not necessarily the same as number of years unless it is annual compounding. So in our example, we are dealing with quarterly compounding, so it is number of quarters. Okay, and the cash flows have to be signed. In other words, they have either negative sign or positive sign unless the cash flow is 0. So how do we sign the cash flows in Excel functions? Well, cash inflows have positive signs. Okay. Cash outflows have negative signs. All right. So let me explain what is a cash inflow, what is a cash outflow. All right, so cash inflow basically means money flows elsewhere into your pocket, and later you can take the money out and use it for your consumption purpose. Cash outflow means money flows from your pocket to elsewhere. Okay, so if you actually make a deposit, well, if you make a deposit, you take the money out of your pocket into your bank, put that into your bank account. So it's a cash outflow today. All right, and later, if you want to withdraw, all right, after earning satisfactory interest, a withdrawal, well, you're going to have cash inflow because money is going to flow from your bank account into your pocket. All right, and that's a cash inflow. Okay. So that is probably a very easy way of understanding the inflows and the outflows. So in this case, this person is actually investing. So investing is like making a deposit. All right. So, you have negative signs before the 5,000. That's why I'm signing this 5,000 here as negative. Okay. Now, if you actually take out a loan, well, if you take out a loan, money flows from the bank into your pocket. Okay, it could be for a vacation. All right, so that's a cash inflow. All right, so a loan today has a positive sign, and if you're paying off the loan, well, when you are paying off the loan, money flows out of your pocket to the bank. So that's a cash outflow. So when you're making payments, these are cash outflows. Okay. All right, so these are very subtle things, but they are very important. All right. Finally, for single cash flows, payment argument is set to 0. Okay, so if you look at our a function here, you see that when I move my cursor to the payment argument, Excel is actually highlighting this argument here. It's putting this in bold, and I put down a 0 here because this is a single cash flow. Okay, so I don't have to worry about the payment. I can even actually skip the zero, just put a comma there. All right, so that is example number 4. All right, let me look at example number 5 here. All right, so Wilkins McAlber has just received $20,000 and he's thinking of saving this for his retirement plan that is actually 15 years away. First National Bank offers 7% interest on a 15-year deposit, compounded annually. Second Bank, offers 6.9% interest, but compounds monthly. What should this person do? All right, so we're talking about saving. All right, so this is our brief analysis. All right, we're talking about saving 20,000 for 15 years. Okay, and we have 2 banks. All right, and different rate and different case. Okay, different compounded frequencies. So the question is, which bank do you want to go to? All right, so what's the solution here? What's the analysis here? Well, the solution is very simple. So standing today, we know exactly the interest rate and the compounded frequency from these 2 banks. So I'm just going to do the calculation for the future value. And I will go to the bank with the higher future value. Right? Because you're making a savings. You're making a deposit. Okay, so I need to calculate the 2 future values here. All right, so future value was First Bank, and future value was Second Bank. Okay, and again, I'm going to do this by doing both the formula and the function approach. Okay, so I'm going to actually go ahead with the Second Bank here because the Second Bank is actually doing 6.9% interest, but monthly compounding. All right, so if I want to calculate the future value with the Second Bank, I'm going to do 20,000 multiplied by 1 plus the interest rate, which is 6.9%. That's annual rate. It's divided by 12. Okay, raised to the power of, well, this is actually for 15 years, so 15 times 12. All right, so that will get me the future value for the Second Bank. All right, so now that's 56,000 of 135. And I want to actually replicate this number by doing the function here as well. So I'm going to do the future value function here. The rate is 6.9% over 12. Remember, everything is in periods. Okay, and number period here is 15 years times 12. And the payment is 0, as we're saying. This person only makes a one-time savings of 20,000 and no other savings in between until 15 years. And present value is a negative 20,000. Okay, it's negative because it's a savings, so it's a cash outflow today. All right, so yes, I just replicate the number here. All right, so I'll leave it to you for you to figure out a future value with the First Bank. All right. So that is a very simple discussion of a few things you have known already from your first class in finance. But we're moving to Excel. You see that there's a lot of little things for you to be care for. All right. So for example, the cash flows are signed, and you see that here the comma is actually used to separate the arguments for this Excel function. Okay. So in accounting, people use comma to separate the digits. Here, we don't do that. We actually use the comma to separate, the arguments in the Excel functions. All right. And if you're actually using comma to separate the digits, Excel function is going to think of that as different arguments, and that's not what you mean. All right. So that's example number 5. Okay. Example number 6. All right, you can earn 0.45% per month at your bank. If you deposit $1,500, how many years must you wait until your account has grown to $3,600? All right, so interest rate, 0.45% per month. Okay, so this is already a monthly interest rate. And if you deposit 1,500, okay, so the present value is 1,500. And if you want to actually have 3,600, so that's going to be your future value here. Okay, it's a single cash flow case because you make a deposit of 1,500 and you do not make any other deposits. All right, and the question is, how long or how many years? All right, so the analysis here is, well, first of all, it's a single cash flow problem. Okay, as we said, there is only one deposit. And secondly, the compounded frequency is monthly because the question says your rate is actually 0.45% per month. Okay, and so I'm trying to find the t here. Well, the t here is actually in years. Okay, how many years? So step number one, I'm going to use the NPR function here. Okay, so let's go ahead and play with the NPR function here. The rate is 0.45%. Okay, that's monthly interest rate already. So no need to divide this by 12. And the payment here is 0. It's a single cash flow. The present value is negative. Okay, you're actually depositing. That's 1,500. And the future value is 3,600. So that's when you're going to withdraw your deposit. So that's a cash inflow by the time you withdraw. So that will get you 194.99. So if you think of this as years, that obviously is way too long. All right, you're earning 0.45% per month. So if you actually want to convert that into annual interest rate, you can simply multiply that by 12. All right, so that's about 6% per year, and you don't want to wait for 194 years. So it turns out the catch here is, if you're going to use NPR function here, the answer you're getting is in months. Now I can actually convert this into years. So I have 194 months, so I can just divide it by 12 to get years. That's 16.24 or 25 years. All right, so that's actually my step number 2. All right, step number 1, use the NPR function, and I should actually slow down here a little bit. Step number 2, convert into number of years. Okay. All right, so this seems to be very, very straightforward. But some of you may say, you know what? I want to actually use the NPR function here, and the rate is 0.45%. You told me this is a monthly interest rate, but we're trying to find number of years. So nonetheless, I'm going to multiply this by 12. All right, so I'm dealing with annual interest rate. All right, payment is 0. Present value is negative 1,500. Future value is positive 3,600. So if I do it this way, I get 16.65, which is actually fairly close. But this is not the correct answer. Why? What's wrong here? Okay, what's wrong? So we know that the correct answer is 16.25, and you're getting 16.65. Why is that? The answer, or the catch here, is you have changed the compounding frequency. Okay? The question says you actually earn interest every month. So you're dealing with monthly compounding. And what you're doing here is you convert the monthly interest rate into annual rate. So you have, manually changed the monthly frequency into annual compounding. And that's not appropriate. Okay, so you cannot do that. Of course, if the question says, you're actually earning interest every year instead of every month, then this would be the right thing to do. Okay, so you see that Excel functions are quite, innocent. As long as you feed the function with the right arguments, they're going to spit out the answers. But you have to be very careful which answer is correct, which one is what you need to do. All right, so that is example number 6. Okay.